Welcome to the Deep Dive. We plunge into complex topics, slice through the jargon, and really try to unearth those important nuggets of knowledge and surprising facts just for you. Today, we're taking a deep dive into the Q1 FY26 financial results of Bank of Baroda. Our mission is to cut through those dense reports, find the stories behind the numbers, and help you understand what truly matters.
Absolutely. And we've got a pretty comprehensive stack of sources for this deep dive, everything from the formal financial notifications to some incredibly detailed performance presentations. We'll be connecting all the dots, helping you grasp not just what the numbers say, but really why they're significant for Bank of Baroda's strategy and, well, its future. These results, just for context, were officially approved by their board of directors on July 25, 2025.
Okay, let's unpack this then, starting with the big picture. When we look at Bank of Baroda's Q1 FY26 financial report, what are the headline figures that really stand out? What's the overall story here?
Well, the net profit for this quarter landed at INR 4,541 crore. Now, on the surface, that looks like a modest 1.9% growth compared to Q1 last year. But here's the interesting part. It was actually lower than the previous quarter's net profit, which was over 5,000 crore.
Oh, okay, so year-over-year growth, but a sequential dip.
Exactly. It suggests that while they're growing year over year, there might be some, more recent headwinds impacting their bottom line, something we need to explore. On a more positive note, operating profit saw a really healthy 15.0% year-over-year increase, hitting INR 8,236 crore. So the underlying operation seems strong. However, their net interest income, or NII, which is, essentially the profit a bank makes from its core lending activities that remain almost flat, it actually declined slightly by 1.4% year over year.
Right, so bit of a mixed bag there, isn't it? Strong operating profit, but flat NII and that slight dip in net profit from Q4. That really makes me wonder what's driving the other big story you hinted at, that significant jump in non-interest income. What's going on there?
Ah, yes. This is truly a major story for the quarter. Non-interest income absolutely surged. We're talking an impressive 88.0% year-over-year jump. And if you dig into the details, a huge chunk of that, in fact, a massive 11,129.1% year-over-year increase.
Whoa, wait, 1,100%.
Yes, came from trading gains, specifically profit from the sale of investments. They brought in INR 2016 crore from this alone in Q1 FY26. Compare that to just INR 164 crore in Q1 FY25. Profits from exchange transactions also saw substantial growth, 67.6%, and overall treasury income, driven by those trading gains, jumped by an astounding 654.5% year over year. Even the more predictable fee-based income contributed positively, growing by 9.7%.
Wow, okay. Over 1,000% increase in trading gains. That's where it gets really interesting. But I mean, how sustainable is that really? Is that something the bank can count on every quarter, or is it more of a one-off boost? And beyond that, what about the bank's core business performance, the bread and butter stuff like deposits and advances?
That's an excellent question about sustainability. Trading gains can be volatile, so it's definitely something to watch going forward. It's not core operating income in the same way NII is. Shifting to the core business, though, the bank saw solid and consistent growth there. Global deposits grew by a robust 9.1% year over year, reaching over INR 14.35 lakh crore. What's interesting is their international deposits grew even faster, nearly 15% year on year, while domestic deposits increased by a still healthy 8.1%.
Okay. And within those domestic deposits, any shifts?
Yeah, a slight shift. There was a dip in their CASA ratio. That's your current account, savings account deposits, the cheaper funds for banks, it fell to 39.33%. This suggests perhaps a continued reliance on higher cost term deposits to fund growth.
Makes sense. And what about the other side of the balance sheet? The loans, the advances?
Right, advances. That's where a bank really puts its money to work. Global gross advances increased significantly, up 12.6% year over year. Domestic gross advances were right there too, growing by 12.4%. But here's where you see the strategic shift quite clearly. Retail advances were the standout. They surged by 17.5% year over year. This was pretty broad-based too. Personal loans leading, but also strong double-digit growth across auto, home, and mortgages. Even gold loans saw a 16.4% increase.
So a real retail push. What about other sectors?
Agriculture loans also grew impressively, 16.2% year over year, and MSME loans by 13.1%. Corporate loans, though, had much more modest growth, just 4.2%, and this really shows a clear strategic pivot. The share of RAM, this retail, agriculture, and MSME in their total domestic credit jumped from 59.7% last year to 62.7% in June 25. You can see the bank actively shifting towards these, let's say, higher growth and often higher yield segments.
Okay, so the bank is clearly pushing hard on growing its loan book, especially in retail. That's a major focus. But this raises an important question, doesn't it? As they expand so aggressively in retail, what about the health of those loans? How's the asset quality looking? Is it keeping pace?
Asset quality is absolutely crucial, you're right. And here, Bank of Baroda has shown significant improvement overall. Their gross non-performing assets ratio, the GNPA, that's the bad loans percentage, it improved significantly to 2.28% in Q1 FY26. That's down a healthy 60 basis points from last year.
That's quite a drop.
It is. And their net non-performing assets, the NNPA ratio, which accounts for the provisions they've already made, that also improved, down to 0.60%. The slippage ratio, which tells us how quickly good loans are turning bad, was 1.16%. And their credit cost, basically expense tied to bad loans, was 1.55% for the quarter. What's particularly encouraging, I think, is that their total gross NPA is actually reduced in absolute terms, down from over INR 30,000 crore to INR 27,572 crore. And their provision coverage ratio, how much they've set aside for potential losses, is very strong, over 93% if you include technical write-offs. That signals pretty solid stability.
Okay, that sounds good overall, but are there any sort of underlying concerns, any areas to watch?
Well, yes. While the overall picture is improving, we do see a more nuanced trend when we dig a bit deeper. Retail NPAs, for instance, actually increased. They went from about INR 3,800 crore last year to over INR 5,200 crore this quarter. Agriculture NPAs also rose slightly.
Ah, so the segments they're pushing into are seeing rising NPAs.
Exactly. But on the flip side, corporate NPAs saw this massive reduction. They almost disappeared, dropping from over INR 2,000 crore to just INR 55 crore. International NPAs also decreased significantly, so it's a bit of a tale of two cities, A big cleanup in corporate and international, but some fresh stress emerging in those booming retail and agri portfolios. We also see something called CRIL C SMA1 and SMA2. These are early warning signs for potential stress, stood at 0.40% of standard advances. That's up from 0.18% a year ago.
Okay, so that's definitely something to keep a close eye on, especially with that rapid retail growth.
For sure. Although, despite this, it's worth noting their collection efficiency, how well they're actually collecting payments due excluding agriculture, remains very strong at nearly 99%.
Right. That's fascinating. A great story of overall NPA reduction, largely driven by that corporate cleanup, but yeah, a definite cautionary flag in the rising retail and agri NPAs. And that Crotales data, it really makes you think about the trade-offs of aggressive growth. But let's shift gears slightly. What about the bank's engine room? How's their operating efficiency? And their capital cushion?
Yeah, good point. Even with growth, efficiency is key. Operating expenses did increase, up 13.7% year over year. We saw increases pretty much across the board. Employee costs up 7.3%, and provisions for employees and other operating expenses both jumped by around 22.4%. Within those other expenses, there were some big jumps. Depreciation up 46%, and law charges, surprisingly, up almost 93%.
93% on law charges. But what did that do to their overall efficiency ratio?
Interestingly, despite those cost increases, the bank actually improved its cost-to-income ratio. It came down by 30 basis points year over year to 48.87%. So this indicates better overall efficiency in generating income relative to the expenses, which is definitely a positive sign. And critically, their capital cushion, measured by the capital adequacy ratio, or CRR, is very strong. It stands at 17.61% for the standalone bank. That's up 79 basis points year over year.
So well above regulatory requirements.
Oh, absolutely. Means they're well capitalized, giving them a solid buffer against potential shocks, and importantly, ample capacity to support future growth plans.
Okay, so the bank seems to be managing its costs effectively overall and maintaining a very robust capital base. That's reassuring. But, banking isn't just about traditional numbers anymore, is it? What strategic initiatives are they pursuing that might genuinely surprise us? Things beyond the balance sheet.
This is where I think the fascinating details truly come to life and paint a picture of a bank really transforming itself.
Yeah.
Bank of Baroda is pushing its digital transformation hard. Get this, a striking 95% of all their transactions in Q1 FY26 were digital.
95%? Wow.
Think about that for a moment. For a bank of this scale, that's an enormous shift. And they're not just processing transactions digitally, they're acquiring customers digitally too. Incredibly high digital acquisition rates, nearly 100% for new self-help groups, over 90% for new savings and current accounts. That's huge. They're also making waves in the broader digital payments ecosystem. They ranked second in debit card issuance, third in UPI remittances, third in IMPS beneficiaries. And their digital user base keeps growing. Bob World app users are up 7% year-over-year to 33 million. WhatsApp banking users soared by 52% to over 13 million. They're even embracing the central bank digital currency, the e-rupee, with user wallets up 43%.
So it's not just about customer convenience, it's core to their operations now.
Absolutely. And it extends to lending. They sanction significant amounts through digital channels for retail, MSME, and agricultural loans in the last financial year. This widespread digital adoption really suggests they're aiming for lower operating costs long-term and greater customer stickiness.
Makes sense. What else? Anything else surprising?
Well, beyond digital, sustainability and ESG are clearly major strategic pillars now. They've signed MOUs for a solar partnership and renewable energy projects. They've even identified infra-power renewable energy as a champion sector, and they've got a substantial exposure there already, over INR 18,600 crore outstanding. And they seem to be walking the talk with their own operations, too. Over 200 branches run on solar, reducing thousands of tons of CO2 emissions. Many owned buildings have solar green building certifications. They've implemented a no single-use plastic policy. They've raised over INR 1,300 crore in green deposits since launching their framework earlier this year.
So this isn't just greenwashing, it sounds quite embedded.
It appears so. Their ESG risk rating is categorized as strong, and they have pretty ambitious targets. Net zero emissions by 2057, aligning with India's goal, and a goal to have 50% of their total energy sector financing in renewables by 2029. They've apparently already made significant progress on reducing their own Scope 1 and 2 emissions too. This tells us they're trying to integrate sustainability into their core business and operations, not just treat it as a side project.
Okay, digital sustainability. Anything else?
Yes, and this one is quite human-centric, actually. They've launched something called the BOB Health and Wellness Framework. It's focused squarely on employee well-being. And it's not just, lip service. It includes tangible things like promoting walking and running groups, organizing nature walks, supporting marathon participation with reimbursements. They offer webinars on mindfulness and work-life balance, even digital detox awareness. There are special workshops for women returning after maternity leave or sabbaticals, and they've trained mental health ambassadors within the bank. They even celebrated International Yoga Day pretty extensively.
That's quite comprehensive. It suggests a very forward-thinking approach to human capital, doesn't it? Thinking about long-term success.
It certainly does. It's increasingly recognized as a key part of sustainable business performance.
Right. So these initiatives paint this picture of a bank evolving far beyond just traditional banking services, making significant bets on digital sustainability and even employee welfare. It's a compelling vision. But what about its extended family? How are the subsidiaries and its international operations contributing to the overall picture? Is it all aligned?
That's a crucial part of understanding a global institution like Bank of Baroda. And interestingly, their consolidated net profit for Q1 FY26 was INR 3,469 crore. Now, that's actually down 26.6% year-over-year. The consolidated operating profit was also down slightly by about 2.2%.
Oh, okay. So the standalone bank's net profit was up slightly year-over-year, but the consolidated picture is down. Why the difference?
It reflects the varying contributions from their different entities. Some performed exceptionally well, others perhaps less so, leading to this mixed consolidated picture. For example, their asset management arm, Baroda BNP Paribas Asset Management India, saw its net profit surge by a remarkable 479% year-over-year. Huge growth there. India First Life Insurance also saw an 11.6% increase in gross premium income and improved its market ranking among private peers, moving from 14th to 11th. So good progress in insurance. Bob Card Limited, their credit card arm, also saw healthy growth in active cards and spends. The net profit was only slightly up. And Needle Bank, where Bank of Baroda has a majority stake, showed an improvement in its own asset quality, which is positive.
Okay, so some strong domestic subsidiary performance. What about overseas?
In terms of their overseas operations, performance was also varied, but had some definite bright spots. Bank of Baroda, Uganda, Ltd, for instance, saw its net profit nearly double, up by almost 96% year-over-year. And Bank of Baroda, Botswana Ltd, also saw robust growth, up over 32%. However, Bank of Baroda, Kenya Ltd, experienced a slight net profit decrease. So while some subsidiaries and international branches are really shining, their overall consolidated performance for the quarter did face some headwinds, which offset some of the strong individual performances we saw in the standalone bank or specific subsidiaries. It really underscores the complexity, doesn't it, of managing such a diverse global financial institution.
It certainly does. Okay, let's try and wrap this up. What does this all mean for you, our listener? We've seen Bank of Baroda navigating a pretty complex financial landscape. There's strong growth in its advances, particularly that big push into the retail segment. We've seen impressive strides in improving overall asset quality ratios, mainly cleaning up the corporate book. And we also saw that massive, maybe temporary boost from non-interest income, especially those trading gains, alongside these significant and I think genuinely quite surprising investments in digital transformation and sustainability that go well beyond just the numbers.
Yeah, exactly. If we connect this to the bigger picture, this deep dive into Q1 FY26 really reveals a bank that is, I think, strategically pivoting. Pivoting towards those high-growth retail segments, yes, but also aggressively embracing digital and sustainable banking practices. It feels like they see these as crucial for future relevance. This isn't just about traditional financial metrics anymore. It seems to be about a bank actively shaping its future across multiple dimensions, from its digital footprint and environmental impact right through to its commitment to employee well-being.
So as you reflect on these insights, maybe consider this provocative thought. In a rapidly evolving financial world, how much will a bank's success increasingly depend on its digital prowess and its commitment to sustainability, perhaps even more than just the strength of its traditional loan book? What does Bank of Baroda's strong focus on these seemingly non-traditional areas tell us about the future of banking itself? Something to think about.